Alright, so in this video, basically going to go over buying and selling tests, when you enter exit positions. Now, note that a lot of folks, they will not go through the whole course and they'll just go towards the end and go towards the buying and selling tests. It doesn't work like that. You won't even be able to understand the logic of what he's saying and why he's saying it. So it's really important to go through the course and then go to the buying and selling test, and you'll be easily be able to pick up what he's doing here. Alright, so I don't want to really go through every little thing over here, so I'd rather just go through the study. Alright, so the speed and severity of the decline, and look over here on this chart. You see the speed, market went down and it climaxed. Alright, so climaxed. That's what he's saying. Okay, look for a climax. Alright, that's in 1 and 3. Talk about a climax. Alright, 1 says oversold, 3 says climax and preliminary support, but it all comes down to the same thing, which is it needs the climax. It needs to get oversold. It needs to have high volume and sharp spread. It needs to have ending action. However you view it in your mind, like whatever your thought is about that, it needs to have that type of ending action, that transfer, that whatever. Alright, so that's the first thing. You have to have a climax. The second thing is you have to use the P&F chart. And why? Because the P&F chart needs to show that it went to a price objective. Alright, so you have to use P&F charts with vertical charts. There's no way around it. And the P&F chart will show you that went to target. So that's the second criteria. First is climax. Second is, did it go to its P&F target? It did. It climaxed at the P&F target, the bear target that was obtained from these highs. So now we have two criteria: climax and P&F target. Then what else? He's saying about, oh yeah, based on that you can get in the position, but I don't recommend that. He doesn't really recommend that. It's just that he's very skilled in knowing exactly how to pick the turning point. So you could, but the thing is, don't. Most folks will not. They'll try to pick the bottom and they'll totally screw up. So you want to wait for a base to develop. Alright, so first, climax. Second, it already went to target. So you're probably wondering, what if it stops halfway in that target, blah blah blah. I mean, some target will be hit. Alright, the point is, you don't want to you don't want to prematurely get in, because it's going to be a big problem. That's the whole idea. Don't get in prematurely. Wait until markup is completed or markdown is completed and distribution is occurring. Alright, so now what you have here is a quick rally on light volume. So what he's talking about here is ease of movement. Ease of movement, like right, that bar number 5, it's light volume and it's rally. The ease of movement concept is a bar or a rally, up bar, bar going up or whatever, after the climax, it is able to rally. Why is that important? It's important because it shows that it doesn't take a lot of effort, it doesn't take a lot of force, it doesn't take a lot of volume for price to move up. Alright, that means that overhead supply, there's no overhead supply. There are not a lot of sellers at those levels. If there were, the volume would be quite high. So that low volume rally is actually bullish. And this is a concept that not a lot of people focus on. They always look for high volume, breakout or whatever. But understand that low volume rally after an oversold position, means that the overhead supply has been removed. Okay, now but it needs to be coordinated. You don't want to have a bullshit rally, just an up move and then a reversal. So all of those things like climaxing, oversold position, low volume testing, moving sideways, the ability to rally on low volume in that context means that means what? It means that the overhead supply has been removed. Or how he says it is scarcity of offerings. Yeah, okay. Now, do you need that? No, but it needs to be able to make higher highs and higher lows. And that is given by these bars making higher highs and higher lows. The other thing is the market, the stock should be greater than the market, meaning stronger than the market. If it's not stronger than the market, why don't you just trade the market? So there's some other stuff over there. But, what it all comes down to is right here. I put it over here. This is my viewpoint on it. Um, it's a little bit slightly different than exactly the way he's writing it, but it's all derived from his work. The first is price objective is tag climax plus confirmation. Low volume testing to confirm exhaustion. Then you need a base. So you have to use the 1 point figure chart and the 3 point figure chart, and very clearly you see the base going sideways. You need a base. If there is no base, you won't be able to do any risk reward calculations. So, like, if there's no base, there's no evidence of accumulation either. So it becomes a tricky thing. It can be done, but most times you will have a base, and any bull campaign that is a good bull campaign would most of the time have a base. I'd say at least 75% of the time it'll have some type of base, because they need to hold price in certain area to keep accumulating, and that creates the base. Anyway, what else? It finally gets into springboard formation. But before it gets into springboard formation, the closes start tightening and forming an apex. So, God, this cat. 1 second. Can't find my mouse. So what will happen is you want it to get on the springboard position. So right there, it's in a springboard. It's in an apex. Apex, not exactly the same thing as a springboard, but it could be. Alright, a lot of times the springboard will be at the resistance level as it's bobbing out of resistance or at resistance. In this case, the springboard was at 21, which is right above the apex. Alright, not in the apex, but many times it will be in the apex, and it will be evidenced by clustered closes. So anyway, so you see the tightening and narrow ranges over here, and then it goes on springboard formation and breaks. So just look at the stuff I have here. Price objectives reached, climax plus confirmation, low volume test to confirm exhaustion, a base, and then springboard. Like, it should be narrowing ranges. If you don't know what it means like the force of supply has diminished and the closers are unable to make any progress. When the closers are unable to make any progress, it means the force of supply has diminished, and that will then express itself looking like some type of narrow ranges or tightening formation or a triangle or an apex. Alright, so it gets in that springboard formation, and then bang, it'll have a trigger. He would probably just buy it in the but the springboard formation would be right at that when it pops out. And then other things to consider: relative strength versus market, ease of movement. I explained that already. Bars ability to move up on lower volume, higher high, higher lows. As you can see, these bars have higher higher, higher lows, and I've already mentioned the low volume test, which is just means that the volume has diminished. And a trend line break That's also something that he mentions. He wants to see the stride break, and then he wants, like, he says somewhere to check the 3 point chart. But I think it's important that even if you check the 3 point chart, you also want to check one higher time frame. So if you're trading daily, you're gonna have to use the weekly. Why? Because you need to know those levels. You just need to know those levels, especially in today's market. A lot of time the clarity doesn't come from the daily, especially with stocks. The general trend, the clarity of trend comes from the weekly and monthly, but a lot of it comes from the weekly. So the daily in many charts is very erratic, very erratic. You can't make sense of it. But the weekly, all of a sudden, you see like it's very clean. So anyway, now the way he describes it, you need all of this. You need PNF objective completed, bullish activity, meaning low volume pullbacks, high volume rallies, increasing normally on rallies, decreasing on reactions, preliminary support, stronger than market, downward stride broken as trendline break, high support, higher tops, base forming, estimated probable profit. Okay. The way I describe it is a little bit different, but same ideas. You need prior price objective tag, same as what he's saying. You need a climax and confirmation. That's really preliminary support when he talks about that. He's basically, the climax for him creates that preliminary support. I don't know why it does that, but that's what he said. If you see over here, the abnormal expansion of volume appearing on this date after the sharp extension of the downward move indicates climax of the movement and the development of preliminary support. So how he equates climax to preliminary support, I don't know, but that's what he says. Alright, so I just termed this climax. Stronger than the market, obviously should have relative strength. Trendline break, higher supports, higher highs and higher lows, meaning the subsequent bars afterwards should have higher high and higher lows. That's a bullish indication. And higher closes as well. Alright, and then a base. You need a base because in order to just, you can't do any risk reward without the development of a base. It's just not, that's the problem with not having bases. And also there's no clean evidence that that accumulation has occurred. Now a base may show, base with other indications like a climax within it is evidence, and then low volume and sluggish action, and then coming to a dead center. These are all indications of accumulation. Okay, so that's the thing. This is what you want to do. What he's really adamant on is do not use the vertical chart by itself. Use it with both the 1 point and the 3 point. And this is a very clean example of how this 1 point chart gave you a very small objective. But if you look at the 3 point chart, you will see that there is a terminal shakeout. Anytime you get a terminal shakeout, you have base terminal shakeout, it goes straight down, then goes straight up. Especially on a 3 point chart. On the 1 point, it's like, okay, it's making high supports on its way up and all that. But usually on 3 point chart, it looks like this. When this happens, the moves are significantly big. Alright, if you see, for example, when Trump got elected, there was a terminal shakeout. It went all the way down and it came all the way back up. That was a terminal shakeout. And then you saw what the market did. It went straight up. First times I've seen the SPY go totally, like a momentum stock. It just kept on going without any real rotations, without any pullbacks. It just kept on going straight up. So this is the power of that terminal shakeout concept. They will get rid of everybody. They will reverse it right back up and go up, straight up, with tremendous pressure. And so he indicates that, he says, look, if you're looking at the 1 point chart, you're not going to see the terminal shakeout. If you're looking at a 3 point chart, you're going to see the terminal shakeout. That's what this was, and you'll be able to get a higher price objective. Whereas over here in the 1 point, you get a local price objective, which says it's going to go into resistance at this area. Then there's going to be stepping stone. Yeah, there's all this. But the terminal shakeout will give you a clean, will give you a very clear indication, bullish indication, along with using the 3 point chart. You'll get a really nice move. And that's all, folks. Take care.